the US dollar just did something most people didn't expect. In a year defined by war headlines, oil shocks, and interest rate uncertainty, the greenback quietly climbed roughly 2.5% against a basket of the world's major currencies, and one of Wall Street's biggest banks says this is only the beginning. Welcome back to Microfinance. Today we're breaking down a fresh call from Bank of America that's turning heads across trading desks. The US dollar is set up for a genuinely strong second half of 2026. Coming into this year, the dollar was already benefiting from two tailwinds: strong foreign appetite for U.S. technology stocks, and expectations that U.S. interest rates would stay higher for longer than in other major economies. Bank of America's foreign exchange desk, led by strategist Alex Cohen, says the conditions are lining up for the dollar to keep climbing through year-end, driven by three main forces. The first driver is geopolitical. Ongoing conflict involving Iran and disruption near the Strait of Hormuz have kept tension and oil prices elevated. Even after crude pulled back in June, Brent and U.S. crude benchmarks are still sitting roughly 40% higher than where they started the year, and renewed conflict is pushing them up again. Because oil is priced globally in dollars, elevated crude prices translate directly into stronger demand for the currency, as buyers around the world need dollars to purchase it. On top of that, in moments of geopolitical stress, global investors have historically treated the dollar as a safe place to park capital, adding another layer of support. The second driver is the artificial intelligence boom. U.S. equities have had a remarkable first half of the year, and that performance has been driven almost entirely by AI-related enthusiasm. Foreign investors who want exposure to AI winners, chipmakers, cloud giants, and hyperscalers building AI infrastructure, first have to sell their own local currency and buy dollars in order to purchase U.S. shares. The third driver is the most contrarian: interest rates. Bank of America forecasts the Federal Reserve will raise rates by a quarter point 3 separate times in 2026, a full 75 basis points. For context, the broader market is currently pricing in just one rate hike this year. If Bank of America is right, that's typically bullish for the dollar. Higher U.S. interest rates increase the returns investors can earn on dollar-denominated assets like treasury bonds, money market funds, and corporate debt, pulling global capital toward the U.S. A stronger dollar has real consequences. It can make U.S. exports pricier for foreign buyers, pressure emerging market currencies, and raise the cost of dollar-denominated debt worldwide. What's especially notable is how these three forces reinforce one another. Elevated oil prices and heavy AI-related spending both add to inflationary pressure, reducing room for rate cuts. If that cycle continues, Bank of America argues, the dollar's gains this year may reflect something structural: the continued relative strength of the U.S. economy compared to the rest of the world. Looking ahead, watch developments around the Strait of Hormuz, AI capital spending trends, and, most importantly, what the Federal Reserve actually decides to do in the coming months. So here's the bottom line. War-driven oil strength, AI-fueled capital inflows, and an aggressive Fed outlook are working together to keep the dollar on solid footing through the rest of 2026. If you found this breakdown useful, hit subscribe so you don't miss our daily coverage of the stories moving global markets, and drop a comment telling us where you think the dollar heads next.